Today is Friday, 30th of May, 2025, 6 a.m. Eastern Time. This news is brought to you by Preeti Capital, your trusted source for financial insights. The financial markets displayed a mixed momentum as the trading week drew to a close. Technology stocks were at the forefront, driving gains and illustrating the sector's continued resilience and innovation-driven growth. The optimism surrounding tech can be attributed to robust earnings reports and advancements in artificial intelligence, which have fueled investor enthusiasm. However, while the tech sector enjoyed buoyant performance, the broader market was tempered by lingering geopolitical uncertainties. These global issues have cast a shadow over investor sentiment, leading to cautious positioning in other sectors. The mixed signals were evident as major indices posted varied movements. The juxtaposition of tech-driven exuberance against a backdrop of geopolitical tension encapsulates the current market landscape, where investors are balancing optimism with prudent risk management. Meanwhile, commodities and currencies have been reactive to these broader geopolitical cues, further complicating the investment environment. Commodity prices showed fluctuations as traders weighed the potential impacts of geopolitical developments on supply chains and trade dynamics. Similarly, currency markets were not immune to these influences, with exchange rates reflecting the ebb and flow of investor confidence across different regions. In sum, today's market activity underscores a complex interplay of optimism, driven by sector-specific growth, and caution, stemming from global uncertainties. Investors are navigating this environment with a keen eye on both corporate performance and international developments, suggesting a nuanced approach to portfolio management as they seek to capitalize on opportunities while managing potential risks. As we move forward, the ability to adapt to these dual forces will likely be a key determinant of market performance. The major stock indices demonstrated mixed performances, reflecting varying investor sentiments across global markets. In the United States, the indices showed modest gains. The broad-based index advanced by 0.40%, signaling investor confidence amidst a landscape of economic data and corporate earnings reports. Similarly, the tech-heavy index rose by 0.39%, indicating that demand for technology stocks remains robust, likely buoyed by strong sector earnings and innovation trends. The blue chip index also experienced an increase of 0.28%, suggesting steady investor interest in established companies, potentially driven by favorable macroeconomic indicators. In contrast, the small cap index climbed by 0.34%, pointing to renewed interest in smaller, domestically focused companies. This rise may reflect optimism regarding the domestic economic outlook and potential policy support for small businesses. Meanwhile, the volatility index decreased by 0.67%, highlighting a reduction in market uncertainty and a calmer investor sentiment, possibly due to stabilizing geopolitical conditions or positive developments in fiscal policies. Across the Atlantic, the leading UK index saw a marginal decline of 0.11%. This slight dip could be attributed to ongoing concerns about economic growth and inflationary pressures. On the European mainland, the key German index fell by 0.44%, potentially reflecting investor apprehension about the region's economic recovery and energy supply challenges. In Asia, indices exhibited more pronounced declines. The Japanese index dropped by 1.06%, possibly as a result of profit-taking activities and concerns about global economic slowdown impacting exports. The significant decline of 1.52% in the Hong Kong index suggests heightened worries over regional economic tensions and regulatory uncertainties. Finally, the leading Chinese index experienced a 0.32% decrease, likely influenced by ongoing issues surrounding economic reform measures and domestic growth targets. These movements in major indices underscore a complex global economic environment where regional factors and broader market trends interplay, shaping investor behavior and market dynamics. In the current financial landscape, bond yields are exhibiting notable shifts, with market dynamics reflecting broader economic sentiments. The yield on the 10-year Treasury note has dipped to approximately 4.42%, marking a decline of about 1.18%. This movement suggests an increase in bond prices, likely driven by heightened demand, as investors seek safety amid potential economic uncertainties or expectations of stabilizing interest rates. The 13-week Treasury bill yield has edged up slightly to 4.23%, reflecting a minor increase of 0.12%. This modest rise may indicate a nuanced market response to short-term interest rate expectations or adjustments in liquidity preferences among investors. The relative stability in short-term yields, compared to longer durations, often underscores the market's anticipation of near-term economic conditions remaining relatively unchanged, or at least within a predictable range. Conversely, the 30-year Treasury bond yield has seen a reduction to approximately 4.92%, a decrease of about 1.05%. The decline in long-term yields can be interpreted as a signal of investor confidence in future economic stability, or a belief that inflationary pressures may subside over the longer term. When long-term yields drop, it often reflects a market consensus that future rate hikes may be less aggressive than previously anticipated, or that economic growth might slow, prompting investors to lock in current yields for extended durations. These movements in bond yields collectively provide insights into investor sentiment and economic outlook. The flattening of the yield curve, where short and long-term yields converge, can sometimes precede economic slowdowns. However, it's crucial to consider these trends within the broader context of global financial conditions, monetary policy shifts, and geopolitical developments. As such, the bond market remains a critical barometer for assessing economic health and future monetary policy directions.